Okay, so you and your new business partners have started your LLC. You're out there starting to do business in the world. And the question occurs to you, how in the world do we report and pay our taxes? And so in this video, I want to show you how taxes generally work for a partnership LLC. So that would be an LLC that has more than one owner. And I want to clear up any kind of confusion or uncertainty about what you need to know and how you need to handle your business taxes for your partnership. Hey, if you don't know me, I'm Neal Rice. I'm a longtime business attorney. I've helped over 1,000 people start, build, buy, grow their business. And I want to do the same for you through Startup University. So let's get into it. Now, if you watched any of my videos, you know the way I like to represent an LLC. Well, first off, I strongly encourage you to start a limited liability company or another entity that has limited liability protection, but in most cases, a limited liability company. And do that before you go out and start doing any kind of business in this world. That LLC is going to provide you with limited liability protection. That's protection of your personal life and your personal assets from business risks, okay? And you want to have that in place. Now, the way that I represent an LLC is I always think about it as a box. So this box here on the screen is your new LLC. And anytime that you have an LLC with more than one owner, then that LLC for tax purposes by default is going to be considered a tax partnership. So let's just say in this LLC, there are two owners, and let's say that one of those owners has 45% ownership in the company, and the other has 55% ownership in the company. So we have two owners of this LLC, or two in LL speak, two members of the LLC, and these are the proportion ownership. So this LLC is out there doing business. It's making money. Money comes into the LLC. It also takes money to make money. In other words, you have business expenses, reasonable and necessary business expenses for which you can take tax deductions or deductions against that business income, okay? So you have income coming in for the good or the service that you're providing the community. You've got business expenses going out, and basically at the end of the year, you'll have money left over, Lord willing, and I think you will if you follow what we teach here at Startup University. And so there'll be profit, which would be money that came in excess of money that went out as business expenses. And so this profit then, the question becomes, how does that get taxed and who pays that tax? So what I want to talk to you about is the default rules that the IRS has for an LLC that has more than one member or owner. And so the LLC is going to be treated by the IRS as a tax partnership. Now, what that means is, in this case, the LLC itself will actually file a file a partnership tax return. So here in this case, the LLC itself, the entity itself, is going to prepare a partnership tax return. And then in most partnerships, this is the default, in most partnerships, the profit that tax return shows gets passed out through a form called a K-1. And so in this case, there would be two K-1s associated with this partnership tax return. One K-1 is going to say, hey, this member is attributed 45% of the total profit for the year. And the second K-1 is going to say, this member, the second member, is attributed 55% of the profit of the partnership for that year. So each of these members, member one, member two, each of these members are going to receive a K-1 that is the partnership explaining to them and passing out to them their portion of the partnership profit for the year. So each of these members is then going to take this K-1 and they're going to add that into their personal income tax return. Okay, so if there was make my math easy, right? If there was $100,000 of profit, let's say this is member one, member one's going to get allocated $45,000 of that $100,000 profit. 45% of $100,000, $45,000. Over here on their personal income tax return, that same $45,000 is going to get shown on their personal income tax return, and they'll pay that at whatever their personal income tax rate happens to be. Okay? So the partnership itself is not paying tax. The partnership itself is not getting taxed. The partnership is simply preparing a return that explains the overall profit, taxable profit of the partnership for the year, and then providing one of these K1 statements to each of the partners. Those partners then show the K1 statement, which is their portion of the income, on their personal income tax return, and they pay tax on that money at whatever their personal income tax rate happens to be. So you can see it's possible that, member one and member two would actually pay a different tax rate on their portion of the profit, because the tax isn't dependent on the amount of profit that the partnership made. The tax rate is dependent on the personal income tax rate of each particular partner, and that's the rate that they pay on their portion of the profit. So in some cases, you might have a partner that has, a lot of income from other investments, maybe another business, or maybe they have a part-time job. And they might, even if it were a 50-50 partnership, one partner could have a much higher tax rate than another if that other partner has, either other income that's increasing their taxable income, or more personal tax deductions. And so, it's not exactly that each partner pays. In fact, it would be unusual that each partner would pay the same tax rate on their portion of the profit. It would totally depend on their personal tax situation, because the profit of the partnership generally gets passed out onto your personal income tax return, and each partner's personal income tax planning and other income will ultimately affect how much tax they have to pay on their share of the profit. So, hey, I hope that clears some things up for you about how an LLC that is a partnership gets taxed and how that all works. Now, of course, a partnership can elect a different tax status. You can elect an S corporation tax status, a C corporation tax status. You would do that in conjunction with your tax professional that you work with to make sure that that would be a good move for you and your business. What I'm showing you here is simply the default that the IRS applies to an LLC with more than one member, and that would be the partnership tax classification. Now, I prepared a planning tool that I want to give you for free. I think it's really going to be helpful to you if you're a new business owner, if you're thinking about starting an LLC, and it's called the Big Four, the taxes you must know. And I want to give it to you for free. All you have to do is comment taxes down below, and I'll make sure that you get it. Has this been helpful? If so, I'd love for you to check out my course, Startup University, and it's where I transform people from timidity and uncertainty to confident, bold action in their business. And I want that for you. So check it out at www.startboldnow.com, startboldnow.com. Remember, there is life-changing power in a new business. You've got this. I'm right here with you. Let's go.